talking about the method of evaluation is really important because understanding the investments is understanding how it works and why we believe in it, and it is a very simple business to understand. So the net operating income is basically the profit, what ends up at the bottom line, is divided by a market factor called a capitalization rate. So depending on markets, these can range from 4%, somewhere on the West Coast could be even lower, to 7.5% is pretty much a good wheelhouse where we are right now. These do change with the economy, but they change relatively slowly. And to get the value is the NOI divided by the cap rate, and we end up at a number. So to give you an example of the power and how quickly this can change values is, let's say we have a 100-unit apartment community, and I'm just sticking to round numbers so we can all follow this. 100-unit property that we look at and we go, man, these rents are short by about $40 a month. We could increase everyone's rent by $40 and would still be in line with the market. So when we evaluate, we always look at the market. What are the comparable properties doing? What are people paying for rent in the area? So we find a property and we go, this property, we could at least bump $40 on the rent. We then look at the expenses and say, man, I think they're paying too much for landscaping, or maybe their water is out of whack. When last did they do utility conservation? Things like low flow toilets. So going from a 3-gallon per flush toilet to a 1.6 gallon or 1.3 gallon. There's all sorts of things that we can look at, but we do that and we identify $1,000 a month. We think about a 100-unit community, $1,000 a month. I'm pretty sure we'd find a way to cut $10 from the expenses. So, if we do that, it's a $40 rent increase and a $10 cut in expenses. All right, that basically gives us $50 extra a month per apartment. What does that look like in terms of value? So here's the calculation. We may not necessarily even have to invest any money in getting that $40 rent bump. And we've actually got a property where we've increased rents from anywhere from $100 to $140 with not spending a penny. It's just, that's where the market is. And when we acquired the property, there was a huge, what we call loss to lease, where the previous owner had not kept up with the market. So we came in and said, man, there's a lot of runway. We did no improvements and are renewing rents at $100 more to $140 more. So to give you that, come back to this, $40, we could get that done without spending any money on the property. Again, we look at, maybe we're paying the landscaper too much, or maybe we overstaffed with maintenance, or they're contracting out AC work. Yes, sir. How much are you paying for that 100-unit property? It depends on the market. It really does. How much? So it could be anywhere from $30,000 a door to $60,000 a door. I can, the one we were in, we paid $40 a door, and yeah. So we'll come back to those. So yep, you can see the net effect there would be $600 per unit per year is the swing that we've made the property more profitable. $60,000 a year divided by a cap rate, that would be $1 million increase in value. Now, there's things like vacancy and all other business aspects that go into this. So this is not a real life calculation, but it just helps you follow the method of how it happens. But just by doing those two small things, we can increase $1 million really quickly.